So another current liability are short-term obligations that you expect to refinance. So what are we talking about here? This is mostly a timing issue. You have the balance sheet where the books close at 12/31, okay, so you close the books on 12/31. January, February, you're doing the audit, and then in March the reports come out. So what we're talking about here is how are we going to classify things on this date, depending on what happens between then and when the financial statements come out. Okay, so if you have short-term obligations that you expect to refinance long-term, then you can actually classify them as long-term on those financial statements if management has the intention to refinance short-term debt as long-term and they have the ability to do so. So ability means it's already been refinanced by the balance sheet date, or they've entered into a financing agreement with the clear terms. So we go back to the general rule: if a liability is going to use current assets to pay it off, we have to classify it as short-term, otherwise long-term. So intention and ability. So this is where you just kind of have to keep track of the timing on this one. And US GAAP is different from international GAAP on this. If the short-term debt has already been refinanced, or it has the ability, management has the ability and the intention to refinance it, then according to US GAAP, you can classify that as long-term debt on that 12/31 balance sheet, even though nothing happened until, say January, February. IGAP is different. The refinancing has to have been done by 12/31 in order to classify it as long-term, otherwise it has to be short-term. Okay, so let's just take a look at what this might, what this might look like here. So if we look at exercise 13.8, the company has $1.2 million of short-term debt payable in February, and that's at 12/31/17. So in January, the company issues 25,000 shares of common stock and gets $950 proceeds after brokerage fees, and uses that to pay off that note in February. Okay, so the note that's due February 2nd has been paid off using $950 of the proceeds of the sale of common stock and $250 cash. So how do we classify this? Well, the first question is how much of our current assets were actually used to pay that off, and the answer is $250, because the rest came from your long-term stock. Okay, so if you get to the balance sheet, and there's a couple of different ways you can classify it. You can say current liabilities would be $250, and you'd have a note, and long-term debt would be the rest of it. This is how it would be. It would have been classified on the 12/31 statement, because remember, it was still there then. It didn't get paid off till February. So this would be the appropriate way to do it under US GAAP. And then you could also do, just a little bit different format on that. Okay, so that's your short-term obligations that you expect to refinance.